It is late October 1907, and the air in New York City is cold. But the sweat on the brows of the men standing in line on Wall Street is real. They are standing in a queue that stretches for blocks, winding around the corner of Broadway and Wall. They are not waiting for tickets to a show. They are waiting to get their life savings out of the Knickerbocker Trust Company. And they are about to be disappointed. Inside the marble lobby, the clerks are frantically counting cash, but the vaults are running dry. At exactly 12:30 p.m., a man steps out onto the steps and makes a terrifying announcement. The Knickerbocker is closed. The doors slam shut. The crowd erupts. Panic, like an electric current, shoots through the city. By the afternoon, runs have started on the Trust Company of America and the Lincoln Trust. The contagion is spreading. The banks stop lending. The stock market crashes. The interest rate on overnight loans hits 100%. The United States of America, the rising industrial giant of the 20th century, is in the grip of a financial heart attack. There is no Federal Reserve to call. There is no deposit insurance. There is no bailout fund. The government in Washington is helpless, operating with a slow, clumsy Treasury Department that keeps its gold locked in vaults while the economy burns. In this moment of total paralysis, the fate of the nation falls onto the shoulders of one man, J.P. Morgan. The 70-year-old titan of finance, suffering from a severe cold, is playing solitaire in his library at 219 Madison Avenue. He is the de facto central bank. Over the next 2 weeks, Morgan will bully, threaten, and force the other bankers to pool their money to save the system. He will literally lock them in his library and refuse to let them leave until they sign a pledge to provide liquidity. He saves the country. But as the panic subsides and the smoke clears, a terrifying realization settles over Washington, D.C. The United States cannot rely on the health and goodwill of one elderly billionaire to survive. They got lucky this time. Next time, Morgan might be dead. Or worse, he might say no. This is the story of the law that was written in the shadow of that panic. It is the story of the Aldrich-Vreeland Act of 1908. It is usually a footnote in history books, a mere stepping stone to the Federal Reserve. But that is wrong. The Aldrich-Vreeland Act was a radical, desperate, and brilliant piece of emergency legislation that fundamentally changed the definition of money in America. To understand why the Aldrich-Vreeland Act was necessary, you have to understand the fatal flaw of the American banking system at the time. The U.S. was operating under the national banking acts of the Civil War. The currency, the national banknote, was considered the safest in the world. It was backed 100% by U.S. government bonds. If you had a $5 bill from the First National Bank of Peoria, you knew it was good because the bank had bought $5 worth of U.S. debt and deposited it with the Treasury in Washington. It was a hard currency, but it was also a stupid currency. It was inelastic. The supply of money depended on the supply of government bonds. If the economy was booming and businesses needed more cash to pay wages or buy inventory, the banks couldn't just print more money. They first had to go out and buy more government bonds to back it. But if the government wasn't issuing new debt, or worse, if it was paying off debt, the supply of bonds was fixed or shrinking. This meant that precisely when the economy needed more money, the system made it impossible to create it. This rigidity was the killer in 1907. When the panic hit, people hoarded cash. They pulled their money out of banks and put it under their mattresses. The banks, drained of reserves, needed to issue more notes to fill the void. But they couldn't. They didn't have the spare bonds. They couldn't buy them fast enough. The money supply contracted violently. It was a liquidity drought in the middle of a fire. The entire country knew the system was broken. The inelasticity of the currency was the buzzword of the day. Enter Senator Nelson Aldrich of Rhode Island. Aldrich was not a man of the people. He was the general manager of the nation, the most powerful man in the Senate, and the father-in-law of John D. Rockefeller Jr. He was the embodiment of the Eastern establishment. He represented the very money trust that the populace hated. But Aldrich was also a pragmatist. He had seen the 1907 panic up close, and he knew that the system had to change. He knew that J.P. Morgan was right. The country needed a way to create money instantly during a crisis. However, the political climate was toxic. The Democrats and the Western populists, led by William Jennings Bryan, hated the idea of a central bank. They viewed it as a tool for Wall Street to enslave the farmer. They wanted easy money, but they didn't want it controlled by New York bankers. Aldrich knew he couldn't pass a comprehensive central banking bill in 1908. It would take years of study and political maneuvering. But the country was terrified. They needed an insurance policy now. They needed a spare tire for the economy, in case it blew another flat before a new engine could be built. So, Aldrich teamed up with Representative Aldrich-Vreeland of New York to craft a compromise. It was a strange hybrid beast of a bill. It didn't create a central bank. It didn't dismantle the old system. Instead, it created a mechanism for emergency currency. The idea was radical. What if, during a crisis, we allowed banks to print money that wasn't backed by government bonds? What if we let them print money backed by other stuff, like municipal bonds, or railroad bonds, or even commercial paper, loans to businesses? This was heresy to the sound money advocates. It sounded like counterfeiting. Print money backed by a loan to a railroad? It seemed risky. But Aldrich argued that in a panic, the problem isn't solvency. The railroad is good for the money. The problem is liquidity. The cash isn't there today. The act proposed allowing banks to form voluntary groups called national currency associations. These groups would act as a collective safety net. If a panic started, the banks in a city, say Chicago, would band together. They would bring their assets, their bonds, and their loans to the association. The association would vet the assets, bundle them up, and then ask the government to issue emergency cash against them. It was a brilliant workaround. It decentralized the emergency power. It didn't require a Bank of the United States in Washington. It relied on the local bankers in Chicago, St. Louis, or New Orleans to police themselves. But the bill faced a firestorm in Congress. The Democrats filibustered. Senator Robert La Follette spoke for nearly 19 hours straight, railing against the bill as a giveaway to the money trust. He argued that the national currency associations would just be cartels for the big banks to rig the system. We are tracking the hidden history of how the banking system was built to serve the elite. We are racing to hit 1,000 subscribers by December 31st, 2025. If we hit that goal, I am going to release the killer video, a deep dive into the secret meeting at Jekyll Island, where Nelson Aldrich and the bankers actually wrote the Federal Reserve Act in total secrecy. I'm afraid to upload it, but if we hit 1,000 insiders, I'll take the risk. So hit subscribe if you want the truth. The Aldrich-Vreeland Act was a two-headed beast. One head was the emergency currency provision, the fire extinguisher meant to put out a panic. But the other head was purely intellectual. The act acknowledged that Congress didn't know enough about banking to build a permanent system. So it created and funded the National Monetary Commission. This was a bipartisan body of senators and representatives, led by Nelson Aldrich himself, tasked with a single monumental job: figure out how the rest of the world handles money. For the next 2 years, Aldrich, the arch-conservative defender of American isolationism, did something uncharacteristic. He went on a listening tour. He traveled to London, Paris, and Berlin. He sat down with the governors of the Bank of England, the Bank of France, and the German Reichsbank. What he found shocked him. He realized that the American banking system wasn't just slightly flawed. It was a primitive relic. In Europe, Aldrich saw central banks that could adjust interest rates to manage gold flows. He saw elastic currencies that expanded when farmers needed to harvest crops and contracted when the harvest was sold. He saw bankers' acceptances, commercial loans that could be traded like cash, which provided liquidity to businesses. He realized that the United States, by clinging to its bond-backed currency and its fear of a central bank, was fighting the 20th century with 18th century weapons. Aldrich returned to America a convert. He knew the US needed a central bank, but he also knew that central bank was a dirty word in American politics. If he proposed one, the populace would burn him in effigy. He needed a plan that looked like a decentralized association, but acted like a central bank. And he needed help to write it. This leads to one of the most famous and conspiratorial moments in American financial history. In November 1910, just a few years after the act passed, a private train car attached to a southbound train left Hoboken, New Jersey in the dead of night. The shades were drawn. The passengers were a who's who of the money trust. Senator Aldrich, A.P. Andrew, the Assistant Secretary of the Treasury, Frank Vanderlip, President of the National City Bank, Henry Davison, a senior partner at J.P. Morgan, and Paul Warburg, a partner at Kuhn, Loeb & Co. Warburg was the intellectual heavyweight of the group, a German-born banker who understood the mechanics of European central banking better than anyone in America. To the conductors and the press, they were simply a group of wealthy men going duck hunting. They used first names only: Nelson, Paul, Frank, to avoid being identified by the staff. Their destination was the Jekyll Island Club, off the coast of Georgia, an exclusive retreat for the super rich. For a week, isolated from the world, this secret cabal drafted the blueprint for the American Central Bank. They debated the structure, the regional divisions, and the balance of power between bankers and the government. This secret meeting raises a fundamental question about our economy. The Federal Reserve was essentially written by bankers, for bankers, in total secrecy. I want to know what you think. Should the government bail out banks when they fail to save the economy? Or should we let them fail to preserve the free market? Go to the comments right now and type "save them" or "let them fail." I want to see where you stand on the too big to fail debate. The document they produced was called the Aldrich Plan. It proposed a National Reserve Association. They carefully avoided the words central bank. They would hold the reserves of the nation's banks and issue a new elastic currency. It was a brilliant piece of technocratic design. It was also, politically, a poison pill. When Aldrich presented the plan to Congress in 1911, it was immediately attacked. It was seen as a creature of Wall Street. Then, the political earth shifted. In the election of 1912, the Republicans split, and the Democrat Woodrow Wilson swept into the White House. The Democrats had campaigned against the Aldrich Plan and the money trust. It seemed that banking reform was dead. But Wilson and his key congressional ally, Carter Glass, understood that the country still needed a fix. They took the Aldrich Plan, the very plan they had denounced, and re-engineered it. They kept the core mechanics, the regional banks, the elastic currency, but they changed the control structure. Instead of being run by a board of bankers, the new system would be overseen by a Federal Reserve Board appointed by the president. It was a compromise. The bankers would run the machinery, but the government would hold the steering wheel. This became the Federal Reserve Act. On December 23, 1913, Woodrow Wilson signed it into law. History books usually mark this date as the victory. The Federal Reserve was born. The problem was solved. But in the real world, signing a law does not create a bank. The Federal Reserve Act was just a piece of paper. It authorized the creation of 12 Federal Reserve banks. But those banks had no buildings, no vaults, no gold, no employees, and no policies. It would take months, perhaps a year, to organize this massive new system. And here is where the timeline becomes terrifying. Remember the Aldrich-Vreeland Act of 1908? It was a temporary measure. It was designed to last for exactly 6 years, giving Congress time to pass a permanent law. The expiration date written into the act was June 30th, 1914. The calendar was ticking down. The new Federal Reserve was nowhere near ready to open its doors. And the old spare tire, the Aldrich-Vreeland Act, was about to expire. The United States was facing a dangerous gap. If a panic struck in the summer of 1914, the old system would be dead, but the new system wouldn't be born yet. The country would be completely defenseless. Then, on June 28, 1914, Archduke Franz Ferdinand was assassinated in Sarajevo. The dominoes of the Great War began to tumble. The entire global financial system, which was centered in London, began to seize up. European investors, desperate for cash to fund the war, began to sell their American assets. They dumped millions of dollars of U.S. stocks and bonds. They demanded payment in gold. On July 31st, 1914, the New York Stock Exchange closed its doors. It would not open them again for 4 months. The panic that hit New York in the summer of 1914 was objectively worse, mathematically larger, and more terrifying than the panic of 1907. The U.S. banking system was facing a run that should have wiped it out completely. But William McAdoo, Wilson's Treasury Secretary, reached into his desk and pulled out the only weapon he had: the expired, resurrected, and despised Aldrich-Vreeland Act. He triggered the law. He sent urgent telegrams to the sub-treasuries across the nation. The Aldrich-Vreeland Act is in effect. Emergency currency is available. Form your associations. It was like flipping a switch on a machine that had been sitting in the corner, unplugged, for 6 years. The national currency associations suddenly sprang to life. In New York, Chicago, St. Louis, and Boston, bankers rushed to meetings. They brought with them their portfolios of assets: commercial paper, municipal debt, railroad bonds. Under the old rules, these assets were useless for creating money. Under Aldrich-Vreeland, they were gold. The associations vetted them, assets, bundled them up, and telegraphed the Treasury. The Treasury responded with physical cash stacks of emergency notes that had been printed years earlier and stored in vaults. When the banks opened their doors on Monday morning, the lines of terrified depositors were there. They demanded their money. And to their shock, the tellers didn't stutter. They simply handed over the cash, stack after stack of crisp new notes. The psychological effect was immediate. A bank run is driven by the fear of scarcity. When you show the public that there is an infinite pile of cash, the fear evaporates. By October 1914, the Treasury had issued over $380 million in emergency Aldrich-Vreeland currency. In today's money, that is tens of billions of dollars. It worked perfectly. There were no major bank failures. The interest rates began to drift down. The Aldrich-Vreeland Act, written by a conservative Republican senator to protect the money trust, was used by a progressive Democratic administration to save the country. It proved that an elastic currency was the antidote to panic. The legacy of the Aldrich-Vreeland Act is profound yet invisible. It bridges the gap between the 19th and 20th centuries. Before 1908, an American panic meant a crash and a depression. After 1914, a panic meant an injection of liquidity. The act taught the American government how to be a lender of last resort. It broke the psychological barrier that said money had to be tied to gold or government bonds. It proved that money could be tied to the commercial assets of the nation, to the actual business being done by its citizens. The Aldrich-Vreeland Act was the training wheels for the American superpower. And once the bike was moving, the wheels were taken off, tossed aside, and forgotten. But for one terrifying summer in 1914, they were the only thing holding the rider up. The mechanism of the act didn't disappear. It became the DNA of the Federal Reserve's discount window. Every time the Fed lends money to a bank against its assets today, it is following a procedure invented by Nelson Aldrich and battle-tested by William McAdoo. So the next time you hear about the Fed printing money to stop a crisis, remember that they are standing on the shoulders of a forgotten giant. They are using a playbook written in the panic of 1907, refined in a secret meeting on Jekyll Island, and executed in the summer of 1914. If you want to know the full story of that secret meeting on Jekyll Island, hit that subscribe button. Join the insiders. Let's uncover the history they don't teach in school. Class dismissed.